March 21, 2026. The world is not in a full-scale war, but tensions are higher than they have been in years. Multiple regions are unstable, conflicts are active, alliances are shifting, and markets are watching closely. Because markets do not wait for official war declarations, they react to uncertainty. The first impact of global conflict is not destruction, it is disruption. Supply chains become fragile, trade routes face risk, shipping costs increase, insurance premiums rise, energy markets become volatile, oil prices react immediately to geopolitical tension. Even small disruptions can push prices higher. This affects every economy. Higher energy prices increase costs for businesses. Transportation becomes expensive. Production costs rise. This feeds into inflation. The second impact is capital movement. During uncertainty, money moves towards safety. The US dollar often strengthens. Treasury bonds attract demand. Gold sometimes rises, but not always immediately. Investors seek liquidity first, then protection. Stock markets react differently. At the start of geopolitical tension, markets often fall, not because earnings collapse instantly, but because uncertainty increases. Risk gets repriced. Investors reduce exposure. Volatility increases. But history shows something important. Markets do not move in one direction for long. After initial fear, they stabilize. Then they adapt. Defense companies often benefit. Government spending increases in military sectors. Energy companies may gain from higher prices. Industrial production can increase in certain regions. This creates an unusual dynamic. Parts of the market fall, other parts rise. So is war bad for markets? In the short term, yes, because uncertainty is negative for risk assets. But in the medium term, markets adjust. They price in new realities. They follow money flows and government spending. Now consider the economic damage. War destroys infrastructure. It disrupts production. It displaces populations. It reduces efficiency. Global growth slows. Trade becomes fragmented. These are real losses, but there is also a different side. Reconstruction, industrial demand, defense expansion, energy investment. Governments spend more, and spending supports GDP. This is why economic data during conflict can look stronger than reality feels. GDP can rise, while stability declines. This creates confusion. Now look at today's environment. The world is not unified. Geopolitical blocs are forming. Trade relationships are changing. Countries are reducing dependence on single partners. Supply chains are being redesigned. This is not temporary. It is structural. Markets understand this. That is why you see volatility, but not collapse. Investors are not exiting completely. They are reallocating. Technology continues attracting capital. Defense is gaining attention. Energy remains critical. But risk perception has changed. Now the key question: are markets going up or down? The honest answer is both. Short-term direction depends on headlines. Long-term direction depends on liquidity. If central banks maintain support, markets remain stable. If financial conditions tighten, pressure increases. War alone does not decide markets. Policy does. Liquidity does. Confidence does. Right now, global markets are in a sensitive phase. Not panic, not stability, sensitivity. Any escalation can trigger downside. Any stability signal can trigger relief rallies. This creates range-bound behavior, sharp moves in both directions. The biggest risk is not immediate collapse, it is miscalculation, unexpected escalation, policy mistakes. Because when uncertainty is high, small events create large reactions. The global economy in 2026 is more connected than ever and more divided than before. This combination creates volatility, not clarity. For investors, this is not a time for assumptions. It is a time for awareness. Markets will continue moving. up and down. But direction will not be simple, because the world itself is not simple right now. If you want to understand markets, you cannot look at charts alone. You have to look at geopolitics, policy, energy, and global alignment, because in times like this, economics and geopolitics become the same story. And that story is still unfolding.